Two kind of people seldom make money in the market: those who know nothing and those who know everything. If you know you are impulsive and short-sighted, and short-term happenings make you lose your long-term focus, then the quotes in this diary will not help. Perceptions may prove you right sometimes. It is not the way to invest. Research have proved that you often go wrong when you go by perception. By the time you form your opinion, the situation has already changed. Number one rule of investing is to never lose money. Warren Buffett say the best time to buy is when there's blood in market. Buy when everybody else is selling, and sell when everybody else is buying. You will stand out as an intelligent investor. Mimicking the herd invites regression to the mean. Warren Buffett says it is only when tides goes out do you discover who's swimming naked. He does not buy it even if it is a good stock, because he knows a stock is good only when it is cheap compared to its valuation. The biggest danger an investor carries is when he thinks he is investing while he is speculating. Buying on tips or on impulse without proper research is what most investors do. Some rely on their trusted brokers. When a harvest is too small to satisfy consumption at its normal rate, speculators come in, hoping to profit from the scarcity by buying. Their purchase raises the price stabilization function, thereby checking consumption so that smaller supply lasts longer. Producer encouraged by the high price further lessen the shortage by growing or importing to reduce the shortage. On the other side, when the price is higher than the speculator thinks the fact warrant, they sell. This reduced price, encouraging consumption and exports and helping to reduce surplus. Remember, you are the average of 5 people who spend most time with you. Stay away from negative influences. There will be many people around you will discourage you, laugh at you, and try to convince you that what you are up to is impossible to achieve. They will try to drag you down to their own level of perfunctory performances. Please stay away naysayers and doubting Thomases. When you have less money, you can experiment more or you can try different rules. It is like learning to swim in the toddler's pool before you try your swimming skills in the ocean is unforgiving. The little pool is forgiving and friendly. Managing your money is more important than the amount of money being managed. Expenditure rise to meet income. It keeps operating against you. Never spend your money before you have it. No matter how great the talent or effort, some things just take time. You can't produce a baby in 1 month by getting 9 Warren pregnant. Warren Buffett. You have to be patient. Wait until something comes along which at the price you are paying is easy. That's contrary to human nature. Just to sit there all day long doing nothing, waiting. It is easy for us. We have a lot of other things to do. But for an ordinary person, can you imagine just sitting for 5 years doing nothing? You don't, so something stupid. An intelligent investor does not invest like the intelligent cricketer plays cricket. He has an advantage over the cricket. He need not to play every ball. He can wait for a favorable ball to come, and you can hit that ball with full force. The market is dominated by untrained traders who do not know how to control their emotions. Alternating bouts of greed and fear decide a trader's investment patterns. When buying a mobile phone, he carries out a vast amount of research about the megapixels of the camera, the GB in the RAM, and the battery life. When investing, he leaves it on Mr. Market to decide for him. If he were to spend half his time on his lakhs of rupees worth of investment as he spends on buying a 20K mobile phone, he would be much better off. He fails to see stock as a share in the business and looks at it as a money-making proposition. A single WhatsApp message can bring a company down. Ability to stay on course in the face of conflicting signals is an important winning trait. Ari Degusse, the ability to learn faster than your competitors may be only sustainable competitive advantage. Don't be gullible. Use life before it uses you. Understand there are no free lunches, and for every action you take, there's reaction. If you follow the rules of professionals, you will lose, since you will end up as much a slave. Instead, recognize that investing intelligently is about controlling the controllable. You can't control whether the stocks or funds you buy will outperform the market today, next week, this month, or this year. In the short run, your return will always be hostage to Mr. Market and his whims, but you can control your brokerage costs, by trading rarely, patiently, and cheaply. Your ownership cost, by refusing to buy mutual funds with excessive annual expenses. Your risk, by deciding how much of your total assets to put at hazard in the stock market, by diversifying and rebalancing. Your expectation, by using realism, not fantasy, to forecast your return. Your tax bills, by holding stocks at least 1 year and when even possible, for at least 5 years, to lower your capital gain liability. Your own behavior. It is not about beating other at their game, but controlling yourself at your own game. Why we shall not buy mutual funds. The average fund does not pick stock well enough to overcome its costs of researching and trading them. The higher the fund's expenses, the lower its return. The more frequently a fund trades its stock, the less it tends to earn. Highly volatile funds, which bounce up and down more than average, are likely to stay volatile. Additionally, funds with high past returns are unlikely to remain winner for long. 2. Question. Why it is hard to find good mutual funds. Why past performance is poor predictor of future. Red flags for MF. A sharp and unexpected change in strategy. An increase in expenses, suggesting that the managers are lining their own pockets. Large and frequent tax bills generated by excessive trading. Suddenly erratic returns. If you are not prepared to stay married, you should not get married. In addition to the earning coverage test, a number of other are generally applied. These include the following. A. Size of enterprise. B. Stock equity ratio. C. Property value. Factory affecting the capitalization rate. A. General long-term prospects. B. Management. C. Financial strength and capital structure. D. Dividend record. E. Current dividend rate. Capitalization rate for growth stocks. Value equals current normal earning 8.5 plus 2 expected annual growth rate. Putting a price on future. Graham feels that 5 elements are decisive. He summarizes them as A. The company's general long-term prospects. B. The quality of its management. C. Its financial strength and capital structure. D. Its dividend record. E. And its current dividend rate. Don't take the single year's earnings seriously. You can get ripped off easier by a dude with a pen than by a dude with a gun. Bo Diddley. Read backward when you research a company's financial reports. Read the notes. Never buy a stock without reading the footnotes to the financial statement in the annual report. One keynote describes how the company recognizes revenue, records inventories, treat installment or contract sales expenses, its marketing costs, and accounts for the other major aspects of its business. Watch for disclosure about stock options, loans to customers, reserves against losses, and other risk factors that can take a big chomp out of earning. Read more if you are enterprising. Defensive investor portfolio to check companies. A. Adequate size. B. A sufficiently strong financial condition. C. Continued dividends for at least the past 20 years. D. No earning deficit in the past 10 years. Thinking that you are safe is very dangerous. Some way there is a weakness you have got to find. You must always check 6 o'clock. Today's investor is so concerned with anticipating the future that he is already paying handsomely for it in advance. Thus, what he has projected with so much study and care may actually happen and still not bring him any profit. If it should fail to materialize to the degree expected, he may in fact be faced with a serious temporary and perhaps even permanent loss. Moderate price-earnings ratio. Current price should not be more than 15 times average earning of the past 3 years. Earning growth. A minimum increase of at least 1/3 in per-share earning in the past 10 years, using 3-year average at the beginning and end. Moderate ratio of price to asset. A current price should not be more than 1.5 times the book value last reported. However, a multiplier of earning below 15 justify a correspondingly higher multiplier of assets. As a rule of thumb, we suggest that the product of the multiplier times the ratio of price to book value should not exceed 22.5, book value 1.5 times 15 earning. B. These requirements are set up especially for the needs and the temperament of defensive investor. To eliminate great majority of common stock, they will exclude companies that are I. Too small. 2. In relatively weak financial condition. 3. With a deficit stigma in their 10-year record. 4. not having long history of continuous dividends. A win-no-win of stock guide. Current asset at least 1.5 times current liabilities. Debt not more than 110% of net current assets for industrial companions. Earning stability. No deficit in the last 5 years covered in the stock guide. Dividend record. Earning growth. Price less than 120% not tangible assets. It is easy in the world to live after the world's opinion. It is easy in solitude to live after our own. But the great man is he who in the midst of the crowd keeps with perfect sweetness the independence of solitude. Ralph Waldo Emerson. Okay, not income or EPS has been distorted in recent years by factors like stock option grants and accounting gains and charges. To see how much a company is truly earning on the capital it deploys its business, look beyond EPS to ROIC or return on invested capital. ROIC equals owner earnings invested capital. Owner's earning equals operating profit plus depreciation plus amortization of growth plus federal income tax paid by company minus cost of stock options minus essential capital expenditures minus income generated by unsustainable rates. Invested capital equals total assets minus cash, short-term investments, and non-interest-bearing liabilities, plus past accounting charges that reduced invested capital. Compare 8 pair of companies. If you buy a stock purely because its price has been going up, instead of asking whether the underlying company's value is increasing, then sooner or later you will extremely sorry. Graham highlights 4 extremes: an overpriced, tottering giant, an empire-building conglomerate, a merger in which a tiny firm took over big one, an initial public offering of shares in a basically worthless company. The most dangerous untruths are truths slightly distorted. G. Cleefesbury. There are just 2 basic questions to which stockholders should turn their attention. Is the management reasonably efficient? Are the interests of the average outside shareholder receiving proper recognition? Okay, never dig so deep into the number that you check your common sense at the door. And always read the proxy statement before you buy a stock. When a company repurchases some of its stock, that reduces the number of its shares outstanding. Even its net income stays flat, the company's earning per share will rise, since its total earnings will be spread across fewer shares. That in turn should lift the stock price. Better yet, unlike a dividend, a buyback is tax-free to investors who don't sell their shares. Thus, it increases the value of their stock without raising their tax bill, and in the return shares are cheap. Then spending spare cash to repurchase them is an excellent use of the company's capital. All this is true in theory. Unfortunately, in the real world, stock buyback have come to serve a purpose that can only be described as sinister. Now that grants of stock options have become such a large part of executive compensation, many companies, especially high-tech industries, must issue hundreds of millions of shares to give to the manager who exercise those stock options. But that would jack up the numbers of shares outstanding and shrink earning per share. To counteract that dilution, the companies must turn right back around and repurchase millions of shares in the open market. Margin of safety as the central concept of investment. How much risk you can take. Theory of diversification is an established tenet of conservative investment. By accepting it so universally, investors are really demonstrating their acceptance of the margin of safety. To sum up, A. Investment is most intelligent when it is most businesslike. B. Know what you are doing. C. Do not let anyone else run your business unless you can supervise his performance with adequate care and comprehension. You have usually strong reason for placing implicit confidence in his integrity and ability. Do not enter upon an operation, that is, manufacturing or trading in an item, unless a reliable calculation shows that it has fair chance to yield a reasonable profit. If we fail to anticipate the unforeseen or expect the unexpected in a universe of infinite possibilities, we may find ourselves at the mercy of anyone or anything that cannot be programmed, categorized, or easily referenced. Agent Fox Mulder, The X-Files. Risk is not in our stocks, but in ourselves. A Daniel Kahneman explains 2 factors that characterize good decisions. Well-calibrated confidence. Do I understand this investment as well as I think I do? Correctly anticipated regret. How will I react if my analysis turns out to be wrong? How much experience do I have? What is my track record? What is my track record with similar decisions in the past? What is the typical track record of other people who have tried this in the past? Okay, if I am buying, someone else is selling. How likely is that I know something that this other person or company does not know? If I am selling, someone else is buying. How likely is that I know something that this other person or company does not know? Have I calculated how much this investment needs to go up for me to break even after my taxes and costs of trading? Am I relying on my willpower alone to prevent me from panicking at wrong time? Or have I controlled my own behavior in advance by diversifying, signing an investment contract, and dollar cost investing? Suppose you act as though God is and lead life of virtue and abstinence, when in fact there is no God. You will pass some goodies in life, but there will be rewards as well. Now suppose you act as though God is not, and spend a life of sin, selfishness, and lust, when in fact God is. You may have had fun and thrills during the relatively brief duration of your lifetime, but when the day of judgment rolls around, you are in big trouble.